Overrated, underrated. Living on the East Coast.
Underrated. I think it's the best place to eat food, get diversity and culture. I love it. You have 4 seasons, although I hate winter, so I guess I like 3/4 of the year.
Yeah, awesome. Real estate investment funds.
Overrated. Overrated for income, but underrated for tax purposes.
Golfing in 40-degree weather. I know it's cold over there, for a good part of the year. My limit is 50 degrees. What about you?
My limit is 50 degrees too. I agree with
Okay.
that. Something about like when there's a 4
Yeah.
in front of it that changes it. But in reality, it depends how long I haven't golfed.
Okay.
So,
Or who's asking you to golf?
Who's asking? But also, no, really, it's about the time. I'll golf with anyone.
Okay.
Old, young, stranger, friend, client, doesn't matter.
Nice.
But 45, underrated if you haven't played in a while, for sure.
Working 60 hours a week. Overrated or underrated?
Overrated if you're not getting compensated for it accordingly, but underrated if you're trying to take it to the next level or be an
Own a
entrepreneur.
business.
You got to outwork the competition.
Welcome to On the Chair podcast with Vince and Polo. We'll be sharing life-changing experiences from people that have built successful careers and fought their way to the top. Within these stories, you'll realize success isn't something you stumble upon. It's something you sit down with, put in the hours, and build from the ground up. Welcome to the chair.
All right, awesome. Welcome, Bryan. Bryan Pham, the head of institutional sales at Percent.com. He has helped them raise over $2.5 billion of funding for their, fund. What would you
So
best
we've
describe?
done over $2.5 billion of private credit syndication, since inception.
Awesome. He's also a father of a 9-year-old, avid golfer.
9-month-old.
Was that what I said?
Yeah.
9-month-old.
Yeah.
9-month-old and lives in Pennsylvania. Welcome to On the Chair podcast. It's a pleasure to have you.
Absolutely. Thanks for having me.
Let's start out. Just tell them a little bit of your background. Where'd you grow up? What was it like in your household? Like, how were your parents? Were your parents into business? What industry were they in? And maybe about your high school, college career.
I'm a first-generation immigrant. My family's from Vietnam. So, one of the first people in my family to graduate from college, work on Wall Street, all that good stuff. But born and raised in New Jersey. Had a great upbringing there. My stepfather, who I call my dad, he raised me since I was 7 years old. I was a successful entrepreneur. Gave me kind of a roadmap for success, never explicitly, because he built a semiconductor manufacturing business and then sold it to a public company. So I'm not an engineer, but that's what he did by trade. But I kind of just saw it by observation. So being able to see success and how it can take place in many different forms. He's completely different from me in terms of personality, how we do things, but it shows that there's a million ways to skin a cat of this.
Oh, yeah.
So seeing him have success kind of instilled in me that I could be successful in my own right, and shows that working hard will help you achieve your goals and your dreams if you just keep going at it, even when you fail. So I went to college at Drexel University in Philadelphia. They have a great co-op program, which basically means you intern for 6 months a year for full time. Instead of going to classes.
Oh, wow.
Which is pretty cool.
That's amazing.
Had three great jobs in the industry, and then started my career at JP Morgan, doing wealth management for ultra high net worth individuals. Was there for about 3 years, and then have been in the private alternative investment space ever since. So everything from private credit and private equity has been my bread and butter, but have done investments in venture capital, hedge funds, real estate, we name it. Most recently, I was working at a single family office, and that's why I decided to join Percent, because I saw the solution that we were providing for various wealth managers and high net worth investors. So a lot of people that I work with and do business with are looking for this high yield monthly current income with downside protection and diversification. So, simply put, if a client gives us $1 million to invest across a number of different private credit deals, on average, we can target anywhere from $120,000 to $150,000 annualized income coming in on a month-to-day basis. So great for people that want to have investments that are uncorrelated to the public markets of stocks and bonds. So you don't have to worry about the volatility and ups and downs of that roller coaster, as well as the current income nature. So for retirees, that are living on a fixed income saying, okay, I just sold my business or I'm retiring from a very high wage W-2 job. How am I going to supplement my income? So instead of having the 4% withdrawal rule, which is very common, take 4% of the principal at the end of every year, and then hopefully it grows 8% a year, and you're still flat. We have the 0% withdrawal in a perfect world. So you don't have to take away from the principal and live off that. So that's just a little bit about my background, but having me double click in that thing.
Yeah. I just want to go back a little bit. What brought you into finance specifically? You may have touched on that, but like
finance, I grew up in a town in Jersey called Cold Snack. There was a lot of my friends' dads and moms that worked on Wall Street. It was like an hour away by bus. So a lot of people lived down in my town and worked for various firms at Wall Street. So I kind of knew what other people's parents were doing. So I had some people were my baseball coaches, and I looked up to them. Right, they were just
so hang on to the thing.
Yeah, a nice guy who taught me how to play baseball, and then he worked at Cantor Fitzgerald, and I was a stockbroker, and then it's cool. And then you see these movies and all this other stuff, and then you start reading about it, and then you start talking to teachers in high schools, and what do you think I'd be good at? I'm like, I gotta think these are the different things you could do with a business degree. Then you go and you get a generic business degree at Drexel your freshman year. You're not sure what you're going to do. So you do finance and accounting. You get your first internship for accounting. You hate it. So then you take away that sound.
Exactly right.
And then you go finance and marketing because you already took some marketing classes. Yeah. So you get a dual degree there. And then you get the internships at finance firms and find out this is kind of where you think you're going to succeed, and you build these relationships with your bosses at the internships and want to take that to the next level. So that's kind of always been in my eye, business major since high school, really, because they actually had high school programs in my area where you could go to a different neighboring town to do like a business or ROTC or theater or English, whatever you wanted to do, specialized for that high school program. So I thought about it. I got accepted in business high school program and wanted to stay with my friends in my high school where I grew up. And then, went to Drexel and the rest is history.
So you went all 4 years there?
Yep. It's a 5-year program.
Oh, 5-year program.
Yeah, because you're doing 3 6-month internships. So it was a 5-year program when I went.
Where did you intern at?
I interned at Exelon, which is a large power company doing the accounting that I was talking about.
Nice.
And then I worked at 2 boutique asset and wealth managers ranging from like 1 to 6 billion in assets in the Philly area.
And was it a paid internship?
Yeah.
Oh, very nice.
Yeah. Almost all of the internships at Drexel were paying you, anywhere from 12 to $25 an hour, depending on what job you got. So it's great. You're working 40 hours a week or more. So, some of the accounting jobs, you worked like a regular accountant. So you were working over 40 hours as a 19 to 21-year-old kid.
Yeah, so it's a little bit different way of college, right? Of learning, of kind of getting your...
Yeah. I mean, you're going to classes, right? You have 6 months of class, and then 6 months of working. So it was a quarter schedule.
Do you recommend that to...
I mean, I got a great experience into it. And one of my business partners, he was at Northeastern up in Boston. They're very famous for their co-op program as well. Okay. Drexel and Northeastern are probably the 2 most popular that have a full co-op program where you're set up to do that. You're not taking classes while you're working. So you can actually learn, right? Yeah. Most internships are 8 weeks, summer internships. By the time you learn something, it's week 6, week 7, and it's done. All right, see you later.
Yeah.
Right. So it's fine, right? It's good. Don't get me wrong. And some kids get more out of it because they can learn in 2 weeks. They're super, talented and or hardworking. Yeah. But in reality, you don't really get in the groove until you're like 2 months into the job, right? Especially as a kid, it's your first job. Yeah. So, having 6 months, then, you have 4 months that you're really actually doing something and adding value.
Yeah. So you're putting yourself out there in the real world. Yeah. While getting some college to kind of give you that foundation. I think that's awesome. Yeah. I mean, I wish if I would have known about an opportunity like that, I think I would have maybe taken that route. What do you think about that, Polo? You think that's something that you would want your kids to kind of try and do? Or
I think for sure it's college is definitely changing than what it was. And for me, I always say my kids, I would like to send them to maybe, hey, go and do an internship at my friend Bryan at Percent, and go and do an internship at maybe one of my in-laws ex companies in the trucking industry, and I think that's, if you want to be in business, that's a lot kind of a better route to take as far as education. But in college, I don't know about you, but for me, the big thing was like the network that I created. And I know on the East Coast and maybe some of the major schools, that's a huge thing, right? If you get accepted into a Harvard or a Yale or a Northwestern, I mean, the network you create there is going to affect the rest of your life.
100%.
There's still that aspect to it, as far as with your kids, for college, but I'm not.
Well, obviously, Bryan, you have some very wealthy, customers, clients that you work with, and you manage, a vast amount of money and of their wealth, that sort of thing. In this podcast, we like giving the next generation or the next set of 15, 18, 24-year-olds, something kind of take away. What are some of the things that you've learned with, or I guess principles that you learned from your clients that you kind of want to share? Maybe some mental aspects or some principles that they've taught you that you want to share or give, or mindsets that you're seeing in them and why they're successful.
The most successful people that I meet, which tend to be my clients or people I do business with, most of them are entrepreneurs.
Okay.
It's really, really tough to get rich per se or super wealthy by working for someone else. Okay. So most of them are entrepreneurs. Going back to what you're saying, is it overrated or underrated to work 60 hours? Most successful entrepreneurs, unless they're super, super lucky, which most aren't lucky, outwork other people. Right? Because they're building it for themselves. So there's times business, they're making less than their friends or peers that are working a W-2 job making six figures, and they're making 50 grand in profit a year, but they're growing something sustainable. And that will have equity value over time that they can sell for millions and millions of dollars. So, I would say that is one thing is always try to outwork other people. That's going to take you to success at your role, at your job, at a corporation, big or small, and then also when you're growing your business. So hard work, it beats talent 9 times out of 10.
100%. I learned that in sports. Actually, I mean, I was always a really petite, smaller kid, and my dad and my coach would say, "Hey, you're smaller. You better work 2 times, 3 times as hard. You better be polish up on your skills." I didn't know you played baseball. How did you play in high school?
No, that was true little league baseball. We're talking 6th grade baseball, and that's actually when I quit. Was when you got to the bigger field. I'm like, you know what? I don't really like this game. I like the sunflower seeds and hanging out with my buddies. That's really what it's about. Like, I was decent enough, but by no means it was not enough action going on for my taste. I like basketball and football growing up. That was the fun sports.
A lot of our guests, we like to ask them some more personal investing questions. Where do you personally like to invest? Tell me about the best deal you've ever invested in. And then, give me a little bit about your worst deals, maybe a funny story or an experience where you lost, a substantial amount of money. Start with, your favorite deal, or what do you personally like to invest in?
Yeah, so personally, I like to keep it simple with a lot of passive investments and stocks. ETFs is probably my go-to for that kind of stuff, where it's, wash, rinse, repeat in terms of dollar cost averaging, X% of every paycheck invested in the stock market across these number of ETFs. And then from there, just act like I don't have it anymore. That's the key, I think, to growing your wealth when you're young too. Even if it's $100 a paycheck, $500 a paycheck, whatever the max you could do to barely cover your living expenses. That's how you're going to compound wealth quickly while you're not making that much money early on in your career. So stocks, plain vanilla ETFs, not getting too crazy with stock picking. There's times where, I've picked great stocks, but you don't sell at the right time, then what's the point, right? I've had 5Xs where I didn't sell at 5X because I thought it was going to be a 10X, and then right back down to where I got it. And I'm like, don't fight back to the 5X. It's like, catching a fallen knife, they say. You don't want to try to do that. There's tons of Ivy League people with, computers that can, process crazy things, and they can barely beat the S&P sometimes, right? So what makes you think you random Joe Schmo can do it?
Exactly.
So passive ETFs across different sectors that you might favor, because you're like, okay, they're going to always need more semiconductors as, technology continues to, advance.
Yeah.
Exactly. So why don't we invest in an ETF that covers that, so you don't have to bet on one semiconductor business, as an example? So stocks and ETFs. I'm biased. I love private credit just because I view it as a fixed income surrogate. So most portfolios are 60-40, 60% equities, 40% bonds, depending how aggressive you want to be. You increase equities. In my opinion, with where interest rates are, fixed income, the returns aren't as great as what they might have been in prior years currently. And, I don't like the volatility of it as well, because it also fluctuates heavily with interest rates, and with a lot of noise, obviously, with people talking about interest rates constantly. And you never know when that's going to happen. So private credit can be a very great fixed income alternative. Nice. You do sacrifice liquidity, because you can't just sell a private credit investment like the way you can a bond. One of my favorite investments I made was a first anchor investment into a new private credit fund that gave me the current income that you want of double-digit, annualized yield with quarterly cash flow, but you got the upside potential of participating in the profit share. So it's the best of both worlds. You're not taking the risk of the downside of getting wiped out in the equity if the business doesn't succeed, because you're investing in the fund as a limited partner, it's called, while still getting a healthy double-digit net return for the underlying investments. That's probably my favorite personal investments. I've made several small seed investments in different businesses that have had varying levels of success, but I would say the most recent one that I really am proud of, that I think will be successful both in the short term and long term, is that seed first anchor investment.
Okay, nice. What about investments you kind of wish you could take back?
Investments I wish I could take back. That's a good question.
Or stock picks that you maybe bought and it went straight down.
Okay, so another example of when you try to do something that you don't really know, because someone else that you think is smarter thinks they know what they're talking about. So I had this buddy of mine, really good guy, when I was working at JP Morgan, and he is like, Bryan, you got to buy the VXX because it tracks volatility within the market. So when he explained it to me, and the way he understood it too, for what it's worth, he is thinking as a hedge for your portfolio, right? So if you have 90%, actually 90+% of your portfolio long, you can hedge this by being essentially short, because it's pricing against volatility. What we didn't know at the time was that it deteriorates over time. So it's not just a hedge, you're also losing money if it's a flat market or it's going up.
So it has a time value to it.
Basically, yeah. So it basically became a zero just by pure time.
That kind of sounds like
exactly. That's kind of a way to think about it, and I'm not even explaining it well. But investing in the VXX, the VIX, that was probably the worst investment that I ever made, because it went to zero.
How much did you invest in that?
Only a couple $1,000 bucks.
Okay.
It's not going to change my life, but the fact that it went to zero and I didn't know that it could go to zero is something that's pretty hilarious now. That's looking back.
Do you ever dabble in options trading in the morning?
I don't.
Like when you wake up?
I'm not a riverboat gambler, so I don't like doing that kind of stuff anymore. Maybe when in my younger days, but right now, once you build a substantial nest egg, at least in my point of view, just given I've seen people lose a lot of money, make a lot of money, lose it quickly too. When you get to that part where you're saying this is a very comfortable portfolio for my age bracket, you're like, all right, let's not get too crazy and risk it all. You want to, whatever you invest in those kinds of deals, assume it's going to go to zero is my point of view. So if you're willing to risk 2% of your net worth on options, knowing that it could 10x, 20x, absolutely. But know that could very well go to zero tomorrow. That's the biggest principle.
I know personally for me, I like, how there's people out there that they go onto Facebook Marketplace and go look at cars or look at trucks. That Facebook Marketplace for me is stock options.
Okay.
I like to throw, 800, 1500 and just kind of see what happens. You know, I check. I think one thing that's not very good is like,
gives him anxiety, though.
It gives me a little bit of like nervousness, and I'm trying to work.
You're checking your phone.
I'm checking I literally am driving, you know, taking wrong turns because it just went up 30%, and I need to stop that. But you know, I like the thrill a little bit. I guess it's kind of cool and addicting. You know. Kind of like gambling, but with a little bit more knowledge to it.
Yeah.
But I mean,
it's gambling.
Well, so
because even the people with the most info that know everything about a company, right? So you have these analysts at big Wall Street firms. They're literally paid hundreds of thousands of dollars, if not more, to know 5 to 10 companies like the back of their hand. They know everything about that financial.
Wow.
And even if they could quit their job, right, at JP Morgan, because technically you're not allowed to trade on these companies that you're an analyst on. So you could quit your job and say, I know everything about this public company. It could be a small cap company, so you can move the needle. But if they knew it, they would put all of their liquid net worth, whether it's $100,000 or $1 million, and put it on an option saying, I think they're going to beat earnings this quarter because I know everything about.
There's always a
and it still
different thing that comes up, or
the market reacts to something that isn't fundamentally
Trump
correct.
Tweets something and everything.
Shut down.
Yeah, I mean, there's just so many things that could change. Again, if every person that was super smart, it's called having a CFA, a chartered financial analyst.
Yeah,
those people are supposed to know everything about these businesses, and they're paid to know 5, 10, not the whole market, 5 or 10. They would bet their whole life savings if they really felt conviction on those options, and they don't do it.
Hey, are there analysts that like just have Trump's Twitter feed on the side just because obviously he can tweet something and the market reacts?
There's absolutely people that trade off of tweets, right?
Yeah.
Tariffs, whatever. And you could trade off that volatility. Going back to, right? So the market will tank more often than good news on those kinds of tweets or news, whatever. And so, yeah, there's definitely people that trade off of that kind of stuff.
Well, and back to what Vince said about the options, he wakes up every morning and throws, whatever, a couple grand here and there. I did that when I was 16, but not with options, with penny stocks. And I learned what margin was, and I understood it, but I had like 10 weeks in a row of up. So I was like, this is just Prince money, right? Like
retirement.
I think I had like 10 or 15 grand, and I traded on margin with like 45 or whatever. I forget the max you can do. And there were days where I would trade a penny stock, worth 3 cents, and it went up to 3.01 cent, and I made $6,000 in 7 minutes in math class in high school. And I experienced that, of the thrill of, oh my gosh, I just made this much money, and as a kid. But I learned right away, like as soon as remember when the Ebola happened? Yeah. Well, everything went down, and I didn't understand. Like, just keep it, just hold on to the stock, and you're good. I had Facebook at that point on margin. I think like 20 grand worth of my money, and it was like at 60 grand with margin. So I had like 60 grand of Facebook, and it shot down like 20% in a week because the whole world was ending. And I sold it because I'm like, I don't know, it's going to go all the way down. Well, now if I would have just kept that, I could have retired off that alone, off the Facebook stock. Yeah. But so I kind of learned early on, for me, like my personality it's way too stressful to be ticking the market, watching the ticks every day, especially if there's a lot of money in there. And like when 1% up, I mean, the market moves in 4, 5, 6% days sometimes.
Oh yeah.
If you have $2 million in there and you go up 60 grand in a day and down 60 grand, and you think about that in real money, it's like, that's a lot of money, and it can really tie to your emotions. So I have chosen like the set it, forget it route. I check it doesn't exist, but I do not pay attention to if it's down 3,000 on the day or 10,000 or up 10,000. That I tried to train myself not to let those emotions affect me. Yeah. And Vince, we're still getting there with him.
Yeah, well, that's why I like percent so much. You're forced to, give and forget. Yeah, because I can't do anything about it.
It's uncorrelated to the market, right? Yeah. So whether it's going up 22% or down 22% in the equities, you're going to be clipping a steady coupon if you're building a diversified portfolio of asset-based private credit, in our experience. Yeah. It doesn't always work. If it does, everyone put all their money in private credit and get, 10 to 15% a year. Yeah. So the key is working with someone that knows what they're doing, can build a tactical portfolio versus, spreading their chips, I like to say, across all 36 numbers on the roulette table, right? And the 2 zeros. But, it's more about knowing what you're getting into, accepting those risk-adjusted returns, and, not worrying about the market going up, down, sideways.
Yeah. So, Bryan, if someone wants to try percent, they're very interested, but they don't know a ton about it. It's a little bit like out of their wheelhouse. There's people that don't even have any stocks.
Yeah.
Right. Mm-hmm. This is a different kind of deal. How little can you try something with?
So the beauty of it is, when we were founded in 2018, we were built to democratize private credit. So this was previously only available to endowments, foundations, family offices, wealth managers that could deploy millions of dollars into these private credit deals. We made a fintech solution and have built a global marketplace that uses our financial services engine, essentially, to diligence, source, and monitor these private credit deals. So it's not as opaque. You can really see, what am I investing in? How is it performing? When am I getting my cash? Did I get my cash on time? Everything from A to Z in terms of, what business is it? It's not just a black box. You're saying it's this company that's based in this state. They've been around since this year, and they've been doing this much revenue each year.
I go to the websites. I check out their, the businesses.
And just for the viewers, like, who polices, and just like, because I can imagine like some, people that maybe aren't educated on that kind of company, who's the organization that makes sure that percent's not putting bad info and that they're doing their due diligence at the SEC?
Yeah. So we're registered with FINRA, as well as the SEC. We have a chief compliance officer. We have an auditor. Nice. We have all the checks and balances in place that are legally required, and then just internally, just best practice, transparency. So you can see all the wins and all the losses on percent.com. A lot of other fintech platforms that you can invest on, they tend to sweep their losses under the rug. So if you weren't invested in that deal, you would never know that they had losses. With us, you can see, we have a 96% success rate, whatever it is, right? And we own our losses, because that just shows that we have the right ethics, I believe, and we're owning everything that happens, the good, the bad, the ugly. But going back to your original question, how much can you invest? By democratizing it, instead of requiring $1 million minimums, some of these deals you can get in as little as $500, which is a pretty crazy concept. The only requirement is that you're an accredited investor. That's the only requirement.
What's an accredited investor for our viewers?
It is someone that makes over $200,000 a year for back-to-back years as an individual, $300,000 a year as a married couple for back-to-back years, or worth over $1 million, or a licensed financial services professional. Have your Series 7, 66, something like that.
So if you're an accredited investor, we'll link Bryan's contact info below, and you guys can ask as much questions. And I like the way you described it. So I just put in $75,000 in, what was the deal called? Do you remember?
Yeah, that was called Spartan Capital.
Spartan Capital. And you kind of described it as, hey, Spartan Capital were raising, I think it was like $20 million for them, backed by, let's say, $25 million of receivables. Like, give me a little bit of that. So if they have defaults, what happens?
Yeah, so that's an example of what's called an asset-based private credit investment. So you have a pool of assets. They could be small business loans, litigation finance cases, medical receivables, that we segregate away from the corporate balance sheet of that borrower and put in what's called a bankruptcy remote SPV. We then file UCCs on these assets, so they can't take loans against them anywhere else. We have DACA controls on the bank account, so if they break any of the covenants in the loan, we go into what's called rapid amortization to get back to principal as soon as possible. But the thing that you're mentioning is called a minimum over collateralization threshold covenant. So at the end of every single month, we make sure they are meeting that collateral dollar amount. So if we loan out $10 million, we have $12 million of good, healthy collateral in that bankruptcy remote SPV. Nice. And at the end of every month, we make sure that that stays at $12 million or about that. If it drops to $11 million, so they're still above $10 million, we say, hey, listen, you broke that covenant. It's okay, but you got to bring it back up to 12, essentially curing it on a monthly basis. If they can't or won't cure it, then they go into the rapid amortization. So now every dollar in that bank account that we control for that SPV that we control goes back to pay back the principal, to pay back 100 cents on the dollar to our investors. So we wind it down if they can't keep up that collateral.
I like what you said about you guys are upfront about your, the default rates and stuff, because to me, when I look at something like that and I don't see any failures or any bad reviews at all, it's like they're hiding something. You know what I mean? On the default rate question, what does that mean? Like if someone, let's say someone puts in $500,000 and they say, hey, I want minimize risk, let's go $50,000 in 10 deals. Does a default mean the 50 is gone, or does it mean they might get back 45 or no interest?
So it goes into what's called workout.
Okay.
Where we're working out a solution. So you can recover 100 cents on the dollar. You can recover way less. It really depends on what's the underlying collateral. Is there any? Right? So sometimes it could be like most of our workouts and defaults have been in what's called venture debt. What that is a loan to a venture-backed company. So pre-seed, Series A, what have you. And the only way that they're going to pay back that money is when they do an equity raise in a subsequent Series A, B, C, what have you. If the equity market for venture capital dries up, it is almost impossible for them to raise the money. And so it's going to be almost impossible for them to pay back the debt they owe. Wow. The reason they do venture debt, which is expensive in terms of cost of capital, meaning how much they're paying the investor. They're paying in the investor 18 to 25% in cash, is so the owners of the current company don't get diluted too much by raising too much equity. So it's risky. And there's a lot of the deals that are lower yielding tend to be a little more conservative, but that's not always true, because sometimes the borrower wants to raise more money. How do they raise more money? Increase the yield, right? Because that attracts investors. So if you want to raise 20 plus million bucks, you're probably going to need to increase that yield in order to do so. So going back to your question though, it's really about avoiding the sectors or asset classes where we've had some workouts and defaults in that venture debt space, But if we're focusing on senior asset-based investments and what I call percent's greatest hits of small business financing, litigation finance, and medical receivables, our success rate is incredible there. Most of those workouts have been, again, in the venture debt space.
They can pick, obviously, what they're going in, and they can say, hey, even though the venture debt might pay 24% on this crazy deal, I'm not willing to do that. Let's do, something that's going to pay 13%.
Yes.
And it's, what they call a sure thing.
Yeah.
Or
not a sure thing. We don't use that word ever. I never say the word sure thing. Run away from someone that says sure thing or guaranteed.
Bad word.
Those are bad words in my industry. So full disclaimer, I've never said that to them ever. But no, in all seriousness though, you're right. It's more about, I say, the bird in the hand, right? Yeah. If you're happy, most people are happy with a net return of 10%, right? If you say, hey, I can say with a very high conviction and based off statistical returns that we've done for the past 7-8 years, that I can get you conservatively, super conservatively a net 10, conservatively a net 11, 12, and semi-conservatively a 13 to 15, they go, Bryan, yes, absolutely, let's do that. Versus let's swing for the fences for these 18s, 24s, etc. And there's a 4% chance that I could lose my principal, right?
What's the highest coupon rate you've seen?
We've definitely seen stuff in the 20s, for sure. Maybe 24, 25 for those venture debts, which is corporate loan is the broader term for it. So a corporate loan can be to a mature business that's profitable. It could also be to a venture business, i.e. venture debt. So,
Well, as we wrap up here, if you were to go, for our viewers, we want to kind of give them something to take away with. And what we like to ask is, if you were to talk to your 16 to 20-year-old self again, Bryan, what's some of the advice you would give yourself? Obviously, so our viewers listening can take that advice and maybe run with it. Obviously there's a lot of hungry kids out there that want to do something. They want to get into private credit. They want to get into stocks. They want to do something. They have the energy, right? They have the mindset and the willpower. what would you tell them? Kind of go back to telling yourself.
Yeah, so this is actually one of the things I'm most passionate about. I'm an advisor on the board of one of these programs at my alma mater at Drexel University. And so some of the things I tell the kids is, number one, always be authentically you. Okay. That's priceless. People love authenticity. People can smell a mile away if you're not authentic. That's led to a lot of my success. Another thing is, it's not what you know, it's who you know. So people aren't joking when they say, your Rolodex is everything. Right? Your network is your net worth. All those sayings are 100% true. Even if you're not in sales, it's easy for me to say because that's my business, is raising capital across different, with high net worth investors, wealth managers, family offices. So I have a network all across the country with all young, old, all walks of life, all over the country, all over the world, clients in Singapore, Hong Kong, Latin America, you name it, right? Wow. So my network is crazy. But even if you're just a regular accountant, you're in IT, you got to have a network of other people you used to work with, your old boss, to get a new job. Because it turns out, whether it's right or wrong, you make more money when you go to another job. Because most of the times you're only getting a raise of 5 to 15%, even 15%. That's a great raise most of the time. Most people are happy with that. But in the grand scheme of things, if you're making $100,000 and you make $115,000 next year after taxes, is that much? Are you changing your lifestyle? You shouldn't be, but some people do. But my point being is, your network is your net worth. So always maintain relationships, friends from high school, college, your old coworkers, your old bosses, mentors, family friends. I mean, leveraging all of those relationships in an authentic way. Don't just reach out to people when you need something from them or you want them to buy what you're selling. You genuinely care about them. I think those are probably two of the most important things, is being authentic and growing out your network is a key to success, very simply put. And again, outwork people. I mean, hard work is something that's being lost by this generation. I'm a millennial. A lot of millennials don't like to work. Gen Z hates work. They're allergic to it, right? They think it's not fair because they see fast money on random things like, this TikTok influencer's a millionaire. Yeah, well, there's you can count them. Right? There's 100 maybe. I don't know. I don't even know. But let's say there's 100 of them making that kind of money. The rest aren't making anything. But you're striving for that fast money. That's not going to happen for you 99 times out of 100. Yeah. So our hard work that'll never go out of style. It won't be AI'd away. Right? Hard work in whatever you're doing is going to beat the competition.
Awesome. Well, thanks for sharing. Yeah.
I was going to mention real quick, I really appreciate that you mentioned that you're first generation from an immigrant family. We are as well. I don't know if Vince ever told you that, but our parents both used to work in the fields, Mexico, U.S., and, that whole thing. And that's really, I feel like we're maybe our kind of, the first generation immigrants got that hunger and got that willingness to work hard, is because we've maybe not ourselves had to go through that, but we hear the stories every day. I don't know if your dad used to tell you what he dealt with, and my dad does. Every time we sit down, it's a reminder of how things were, where we came from. Remember that, and it's always in the back of your head. And you don't deserve this. You got to work hard for it. So that's a big thing, and I don't know. That's really awesome to hear. I did not know that about you. Yeah,
no, I mean, I'm proud of it, right? And I think, you guys are too. Yeah. I mean, everyone is, right? Like, that's also why I'm proud to be an American. You know, I think a lot of people who complain about America, they've never been to another country.
Yeah.
When you guys go back home, when I went back home for the first time, I met cousins that I never met before. And, they're living in a third world in Vietnam, right? That's still a third world, even though there's parts of it that are like New York City. So I thought, wow, one decision away from living just like my cousins in Vietnam, right? I'm not working on Wall Street. I'm not going to college. I'm not meeting my wife. The life is completely different. I'm not having a comfortable, great life. It's different, right? Yeah. So knowing that you should be grateful for being in this country, number one, and then don't use anything as an excuse, right? I've never used anything about where I started, who I am, whatever, is an excuse. That's another thing I teach the kids.
Great point.
Right? People like to have an excuse. Oh, my dad wasn't on Wall Street, neither was mine.
Yeah.
Okay. Like, is it easier? Yeah. But at some point, someone had to do something to earn that right. to hire their nephew or their neighbor's kid or whatever. So life's not fair. That's another thing that I like to get. Life's not fair. So just outwork, play the game, right? If it's in the rules or, do it, stop complaining.
And guys, On the Chair podcast, we're going to be bringing more guests like this that can provide great value to you guys and provide insight, have a lot of knowledge and good things to teach us.
Yep.
Thank you, Bryan.
Thanks a lot, guys.